Welcome to our quarterly economic update. While we have this meeting 4 times a year, we technically have it 52 times a year, as this is a little bit of an insight to what we discuss here internally each week about our clients. And we break this meeting up into 3 different sections. We talk about the overall economy, we talk about the CandorPath portfolios, and then we drop down and talk about each one of our CandorPath clients every single week about what's going on, what changes we need to make, what's happening in their lives. We are a team here at CandorPath. It doesn't just because you talk to maybe one of your point persons, maybe it's Brandon, maybe it's Michael, John, or myself, Matt. That doesn't mean the rest of the team is not working on you and for you as it comes to your financial life. So, welcome to our quarterly economic update. We're going to try to keep this tight to 30 to 45 minutes. And if you're watching this live, we would love for you to make this interactive. If you're watching this on a replay, you can still make it interactive. You're just going to send us some messages via email or talk to one of our team members to get some questions answered. So please utilize that chat feature if you're here live with us. Now, this wouldn't be a quarterly economic update if you just heard me talk for the next 30 minutes. We want to hear from the expert himself. And as always, I'm joined here by our Director of Investments, Mr. Michael Scott. Now, Michael is having a really good start to the new year with a very small exception that he is a University of Miami Hurricanes fan. And as he, quote, cried himself to sleep Monday night, he is now woken up as a new man. Please welcome Mr. Michael Scott to talk through our economic update and maybe a little bit of condolences on his football team coming in second place in the national championship. Welcome, Michael. We're super glad to have you, and thank you for some time today to talk the economic update.
Thank you, Matt. I appreciate that introduction. Monday night was a roller coaster of emotions, some excitement, ultimate, very tough ending. Tough
Yeah.
ending, but can't ask for anything else than having a chance to win the game at the end, and I can feel very good about it, even though we lost. Just to let you know, Alabama got steamrolled a couple weeks beforehand, and my wife will appreciate that comment here. So, moving along a little bit, I wanted to share my screen so you guys can all see this, and we're gonna walk through a couple items here. And Matt, I know you've got a couple questions along the way that
Mhm.
we're going to pop up here, but we're also going to be monitoring chat. There's a Q&A function, so if any questions pop up, we're going to try and answer them. If it makes sense to do it at the time, we'll do it then, or we may wait to the end. But hopefully everyone can see the screen here. And just going to start right into it because while we're going to look at 2026, I think it makes a lot of sense to look at 2025 to start with and see where we've come from. And getting right into it, the market had some pretty good returns overall, irrespective of any asset class. So, looking here at the top left to start with, we have the 3 major US indices, the S&P, the Nasdaq, and the Dow, all very positive, with the S&P up close to 18% for the year, the Nasdaq over 20%, and the Dow about 13%. We want to put this in perspective. 2023 and 2024 also positive years. The S&P 500 was up close to 26 and 25% both times. So,
Makes our job pretty easier, Michael. All we have to do is just put them in the right spots and it goes up. But I'm kidding because it's not that easy. There is a lot of different nuances that go into the makeup of that. And I think what's great here is just showing that it wasn't just one indices we're tracking. We're looking at a number of different indices here and making sure our clients have the right spread because you start to risk after 3 years of really strong performance, what's to come down the road. And I know we'll get to that.
yeah, and wanted to highlight here because fixed income did well, international markets did really well, but for those of you guys looking at here, commodities did extremely well as well, with the exception of oil. And the reason why I don't have a number here for oil is there are so many different grades and valuation on oil. Oil is down 12%. If you look at Brent crude, it's down a little bit, like closer to 20 if you're looking at West Texas Intermediate. Oil was negative, but you look at gold and silver, massive outsized returns relative to the market. And we'll talk a little bit about this later on, but this has a lot more to do with geopolitical issues rather than some structural big shift or change. And we could talk about that a little bit moving forward.
Yeah, and last year, 2025 wasn't without a major sets of headlines. In fact, starting off the year, we had a tremendous amount of volatility. And then there was sort of this lull through the middle part of the year, and then it ended also with volatility as well. And a lot of this is political. And before we even jump into that, just as a disclaimer, as we talk through this, CandorPath itself is politically agnostic, right? Our job is not to have our own beliefs. Our job is to report as objectively as we can. Our clients have beliefs. Our clients are either Democrat or Republican or have a real strong feeling one way or the other. And our job is not to step on those toes. It's to bring as much objectivity to our reporting as we possibly can and make sure the portfolios are structured with sound logic behind that. And I think both sides sort of feed into it. So kind of going on that note, Michael, let's talk through what did last year look like? What were some of those big headlines? And what's going to be kind of unique is when we move over to 26, some of those headlines are still here present this year as well.
Yeah, I mean, looking at these returns, you might not think a lot happened in 2025, but we did have some really interesting issues that come up. And starting up here in the top left, if everyone remembers back to the first and second quarter of 2025, tariffs and the quote, Liberation Day, right around April, was really a issue for the market. We dropped 20% in that time frame, this late first quarter, early second quarter, when tariffs went up to about a 30% average rate. Fast
Michael,
forward a couple months.
30%. Yeah, just 30%. And I see as I kind of look through some of the names of our attendees here today, and we have these conversations about being nervous about the market. I mean, we experienced a 30% decline within that first, chunk of the year. And you reported a second ago what the end of the year looked like. It sort of just kind of goes back to not being reactionary, to have a plan in place, to not think of, well, I'm going to go to cash when things get dicey and go back in when it gets smooth. It really is to maintain a proper allocation because these were news headlines. We fundamentally there was really nothing that changed in our economy. These were ideas that were being put out. Some of them came to fruition, some of them did not, but the market has such a visceral reaction at times. And our job, a lot of times, is to separate that noise from what's actually occurring and what the fundamentals look like. But I remember going through the beginning of that year last year, Michael, with you and I think we even reported on it. We did one of our quarterly economic updates, one of these webinars. And I think during the webinar, we usually do these if you're watching
Mhm.
it live. Of course, it's 12 o'clock here on East Coast time. I think right in the middle of our webinar, Michael was talking about the tariffs. And at the minute, right in the middle of the webinar, the rollback of those tariffs actually occurred. Market goes down 1,000 points and rallies back up again, quite literally in the middle of one of these conversations. So the movement of these headlines were enormous last year.
And that's something to really keep in mind is a lot of these headlines, and we'll talk about it in the sense of geopolitical issues soon, they occur and there is a knee-jerk reaction. But oftentimes it makes sense to let the dust settle because once we got some more clarity on what this 30% average tariff meant, it became clear that this was not necessarily going to last. We put this in place and then we paused it until June and July. And that gave a lot of time for countries to negotiate different deals and do different things. And regardless of how we feel about it, at the end of the day, end of the year, tariff rates were only about 15.5%, half of what they were initially announced back in April. That being said, they're currently in the Supreme Court, and we'll see what that happens or what happens with that decision from the Supreme Court. It's likely at the moment, if you ask my opinion, if you ask me to be a betting man, I would say that the Supreme Court strikes down certain tariffs under them not being set up correctly under the right code, the right law, though they're likely going to not make that money get paid back. They're likely going to say you've got a certain amount of time to figure this out, in which case the administration is likely going to switch to different codes that they can put them under. A lot of technicalities in there, but it's likely that we see some of these tariffs get struck down in the Supreme Court. But once we got through the tariff situation, we went into the one big beautiful bill drama throughout the summer. And that had a couple really interesting provisions that are going to be beneficial for us moving into 2026. The one that affects most of us today is the extension and the made permanence of the Tax Cut and Job Acts of 2017. That's where the tax rates were lowered and compressed, and the estate exemption was raised substantially. Those were set to sunset at the end of 2025, and this bill made them permanent moving forward. Another issue that is going to be really interesting for businesses is the 100% immediate bonus depreciation. Basically, it allows businesses to invest, to buy capital equipment and immediately depreciate it, which really helps on their tax bill today, which in theory should spur business investment now. Additionally, there's a couple things for tips and overtime provisions. Those are very subjective, and there's a lot of math that goes into that. It's not a blanket no tax on overtime or no tax on tips. Matt, I know you're very familiar with some of those provisions in there, but there is some benefits for those that are on tips and overtime. And then finally, we'll talk a little bit about this as well. The senior deductions is 3 years worth of extra senior deductions depending on your income if you're a senior, and also the raising of the SALT caps for those that are in more high tax states. For those that are going to be attempting to itemize, that has been risen, which is a big sticking point for the 2017 Tax Cut and Job Act. A lot of acronyms in here at the moment. Provisions. Matt, any comments on
Yeah, no,
that
I
section?
think again, our job is not to say whether these are right or wrong. Our job is to operate within the rules that were provided to us. So again, as we start this tax season, again, this is being shot here on what are we, January 21st. In about 30 days or so, February 15th, really for us is when things start to ramp up. We're going to see, and I think what's sort of interesting here is let's take specifically the senior deduction. When we did tax planning for our clients at the beginning of the year, which we oftentimes at least have a conversation about taxes and what we expect for, in this case, 2026. Back when we were doing this in 2025, we didn't have the senior deduction, right? The senior deduction didn't come until right around September or so, right in the
Mhm.
middle of the year. So all the planning we did up to that point really changed once legislative changes occurred. And I think the same is what is going to say what you're going to talk about here in a moment when you look at government shutdown and the last point there is the loss of the ACA credit. Again, as I
Yeah.
look at the names of our attendees right now, a few of them are on the Affordable Care Act, and we, put a plan in place for multiple years, and we're facing right now with not having any subsidies. So, so many legislative changes kind of jump up at us throughout the year. Our job is to make sure we stay on top of that and then filter that down to our clients and see how it impacts you. But we can only plan so much, and then government goes and changes something oftentimes in the middle of the year, causes us to have to make a little bit of a switch. So that's always going to happen. That's what you got us for.
Yep. And the government shutdown, taking a look at that, it was long. It was 43 days. And not to diminish those that went without paychecks for that time period, because that's real and that does have an effect on individuals and families. Outside of the loss of the ACA credits, not a lot happened. Market really didn't mind the government being shut down. Not saying that's good or bad, just not a lot of headlines, but not really a lot of market volatility came out of it. Though this, like Matt pointed out, this loss of certain ACA credits is a problem and does affect a lot of people. We'll see what happens coming into this year. I believe the House is forcing a vote on certain issues with the ACA credits. The Republican Party has some other ideas on how to fix healthcare. We'll see how this gets addressed this year. There is likely to be some political movement on this in 2026 as we look forward, but no answer right away yet. And the last two items here, we're going to talk about in some slides down the way here, but the Federal Reserve was a big source of volatility, at least in the bond market and into the equity markets leading into the later part of the year. Chairman Powell's seat is up in May, and the president thought about announcing a new Fed chair early, thought about removing him early. Didn't Was not a great idea for the markets. The markets pushed back a little bit on that, and looks like Powell's going to remain in his position through May, and we'll see what happens after that. All that to be said, the reason why there was so much volatility there is the president wanted interest rates lower. shouldn't be that big of a surprise. There's a couple of reasons why he wants that. One, you can say he's a real estate developer. He's always liked to have lower interest rates. But two, we're seeing the housing market kind of grind to a halt, and we have a house affordability issue. That would be very beneficial to the economy if we could get the housing market to move a little bit. However, interest rates are not the only issue there. We've underbuilt systematically in this country since the 08, 09 financial crisis that's having some issues with housing. But overall, the president wants interest rates to come down. And then finally, geopolitical tensions. This one's going to be right at the forefront moving into 2026. But we had, the Israel-Iran war last year. We bombed Iran overnight last year. And we have the ongoing issues with Russia and Ukraine. And as those headlines come up, the market does get a little jittery on any given day about it. But what we're going to see here is it doesn't seem like it's sticking. And hopefully we'll see some solution to the Russia-Ukraine issue in the not too distant future.
Great recap, Michael. I mean, I feel like, on January 1 of last year, or actually on December 31st, it was like, it wasn't such a bad year. Markets did great. Yeah, we went through a lot last year. I mean, even I
Mhm.
just recall the government shutdown for 43 days. I mean, was that not the longest shutdown I think
It's the
we
longest
ever
one we've
had?
had so far.
Yeah,
Yep.
yeah, long. I mean, there's a lot of unprecedented movements last year that again, if you fell asleep on January 1st and woke up on December 31st, you're like, oh, that was, a decent year. Looked at your portfolio, did fairly well. We went through a lot. Now we are already now we're talking here about 2026, and we're seeing some of these themes carry over, whether it be talking about high valuations in equities, talking about some of the geopolitical risks, talking about some tax law changes that might be coming down the pike. What do we have in store as we sort of take this very early look of 2026? What do we have sort of our themes for this upcoming year?
One of the things that I think is foremost that we have to address is the market valuations. Now, we've had this slide in here for the past couple of years when we do these market updates, and it's really important because we want to understand what is the valuation of the market when we buy it. Everyone hears, the S&P is at 6,000, it's at 6,500, it's at 7,000, or maybe it's lower. What does that really mean? Because there's the price, which is the number on the index, but the valuation is different. It lets you know if you're overpaying or underpaying something, or if you're paying the right price. And it's important to keep in mind after 3 years of really strong stock market performance. And just as a reminder, we had 26% in 23, we had 25% in 24, and almost 18% in 25. We've got a market valuation that's very high. We're at about 22 times. We're actually a little bit higher today because we're almost a month into January. We're about 22 and a half at the moment. We got a high valuation in the market. The average is about 17. Now, there are structural things to as for why that's the case and what's supporting it, and we're going to talk about them on the next slide. But it's important to take a look at this and understand that we're not starting at a position that is undervalued. We're starting at a position that is at least fully valued. And I would make the argument it's not overvalued yet, but it's definitely not cheap. We're definitely paying full price for the market, and we have to understand that when we build portfolios or when we invest for the long term. And when we look at what's supporting the valuation, why do we think the valuation is okay being at 22 and a half times earnings? Let's start over here and look at this chart. This is the profit margin on the S&P 500, how much money on average companies are making. And we're at the end of the third quarter, almost 14%. And if you look at this chart going back to almost the turn of the century, moving into the 2000s, we're almost double at 2002. Looking into right before the financial crisis, we were at 10 and a half. We're up almost 14% on profit margins. It's very, very difficult to have a recession if companies are earning money. And when we think about the one big beautiful bill, why do we think that's has some positives to it for the economy? We go back to keeping tax rates low on consumers because as consumers, we spend money and that benefits companies. They're going to continue to make money. Additionally, we talk about that immediate depreciation. Companies are able to immediately depreciate their investments. That's going to, in some ways, increase some expenses, but it automatically lowers their tax burden. So they're able to put more money in and grow their business and reduce their tax benefit, keeping some margins high here. So we think about that. We're set up pretty well from a business investment standpoint and a consumer spending standpoint leading into this, which helps us support those higher valuations. When we,
That brings up a yeah,
yeah,
that brings up a great point, Michael. I mean, we get so many questions of Matt, the markets are going up. Should we add to it, Matt? Should we be taken away? And we're going to get to that in a little bit in a moment here when we talk about our client portfolios specifically. But I think this is a great slide, as was the one before. The question comes all the time is where should we be placing our money? And I think you even made a funny comment as we were kind of preparing for this, is it's not really the S&P 500 index. It's the S&P 7 or the S&P 493.
mhm.
A big chunk of the stocks did not perform this way. Really, it was a small chunk that pulled up the indices and really sort of made the headlines when it came to the equity markets.
Yep. And we're seeing companies expand out a little bit here. We're seeing, like you pointed out, for the past couple years, a lot of the growth in earnings have come from that top seven, the top 10 companies in the S&P. And when we look at these earnings over here, some of these projected earnings growth moving forward these next 2 years really centers around the other 490 companies beginning to make more money. And they're beginning to do well through the different avenues from increased demand and the way that they can invest in their own companies. So, really looking for that corporate earnings piece to pick up. However, I know we got another slide here coming up on interest rates, and that's going to
Yeah.
be beneficial as well.
Yeah, I was just going to kind of go there, Michael, because this talks about the stock portion of a client's portfolio, but
Mhm.
as we all need a diversifier, we have some fixed income inside of there. So how do interest rates stack up as we sort of look forward to 2026 here? Where are there some thoughts on where current interest rates stand?
So, right now, moving into the beginning of January, the Federal Reserve has set interest rates at 3.5 to 3.75. So they set a range of where they want the rate to be and they keep it within that range. So it's about 3.6, 3.7% right now. And this chart shows the history of where rates have been in this gray line going up and down. You can see post-COVID into 2022, we had that massive rate hike cycle where we get to a flattening out, then we begin to lower rates, then we held them for a little bit, and then we began to lower them again. Over here, we have a range of estimates. We have the long run estimate that the Federal Reserve thinks we should be at, which is about 3%. But then we have where the market thinks we're going to be in green, and then we have where the Federal Reserve thinks we're going to be at. There's a couple things that I think is important to notice. The market thinks we're going to get two cuts in 2026. We're going to go from 3.5 to 3.75 down to 3 to 3.25. That's two 25 basis point cuts. I think the president wants us to be below 3%, and he's going to be able to nominate some people to the Fed this year. I would take lower than 3% federal funds rate this year if you asked me to be a betting man on this. I think we get at least two. I wouldn't be surprised to see the federal funds rate go to 2.75 to 3%, be in that range purely because we get a new Fed president in May who's likely going to be a dove and want to cut rates. The president nominated a governor last year, and he's been asking for a 50 basis point cut the past two times. Likely that he stays on, gets renominated. There's going to be more pressure for the Fed to lower interest rates this year. So I think it's likely that we'll see rates come down more than what the market is projecting at the moment. Where they move past 2026, we'll see. And there's some inflation questions and different issues there. But I think we see rates continuing to come down.
Now, so much of this, as we sort of do this forward-looking portion, as we talk about 2026, are really based upon some of the external factors that are occurring right now, not necessarily inside of our country. Well, maybe they are inside, but really happening outside of our country. So, as we talk about what's pushing the news right now, as we talk about maybe what is pushing some of the knee-jerk reactions of the markets and our economy, we can't not look at what's happening geopolitically, and whether that's what's happening right now in Iran, continuing what's happening in Russia, Ukraine, or what's happening in Venezuela or Greenland for that matter. A lot of things externally happening outside of our country being driven by decisions inside of our country. Michael, can we talk about some of these geopolitical risks and give us some insight onto which one of these may be impactful, which one of these may be a negotiating tactic?
Yeah, it's really interesting right now, and I have a slide on this, although I'm glad you asked me about it. The situation that we're in, right? Because I think we all went to bed a couple weeks ago and woke up that we invaded Venezuela and we went and got a dictator out. Whether you agree, disagree, it's happened, and we have to move on from it. For the point of this conversation, we can discuss that as a country. But we have that situation brewing. We also have the Greenland situation going on that's kind of come out of left field in these past 2 weeks. And again, not saying we agree or disagree with it, but that gave the market some hiccups yesterday, and we had about a 900-point decline on the Dow. Now, the president gave a speech this morning on East Coast time. It was the middle of the day over in Switzerland, where he ruled out the use of force. That we're not going to take Greenland by force, and the market rebounded. We're up about 500 points before we started today on this. So it's important to take a look at different headlines and how they've occurred and what the actual market implications have been from them. So if we look back here, even going back to the early 70s, with the Israel-Arab war and oil embargo, we had a 17% sell-off. It took 27 days for that to occur. Now here, it took a long time for that to come back. And I think it is important to point out back in the 70s and the early 80s, the largest companies in the United States by market cap were almost all energy companies. So a massive issue with oil in the Middle East had outsized effects at the time. If you look today, our largest companies are not Exxon and Chevron anymore. They're Microsoft, Nvidia, different companies. So the economy looks a little bit different. But even so, when we look here through the past, I guess, what is this, 50 plus years?
All right. I'm a child of 79, Michael. Can we not use the 50 number there? I'm 40. I was 2 months old during the Iran hostage crisis. So I don't remember it, but actually for even Libya bombing, I was 6 years old. But in the mid 40s, Michael, can we just say mid 40 years ago, please?
The thing that comes up here is that regardless of how long ago it was or what happened, there's generally a knee-jerk reaction. There is a sell-off. That can't be denied. When something happens, the market tries to move towards safety. But it's also important to take a look that how long did it take to recover? Other than one event in which there was a massive oil embargo when our country was very, very, very dependent on foreign oil, markets recovered relatively quickly. If we think about, going back to more recent days, 18 days, the market declined 10% for the beginning of the Russia-Ukraine war. It took 2 weeks for it to come back. More recently, even last year, the Israel-Iran war, 5 days, we went down 1%, took 5 days for it to come back. On average, looks like we trade down about 11 days for a 5% decline, and then in 12 days, we come back. So you kind of mentioned it very early on with all these headlines that we had in 2025. It pays to not panic, and it pays to take a step back. And you may not like the situation that's going on for very good reasons, but voting with your money generally does not pay off. So it suggests that we should wait, let some of the dust settle, and then we can make changes if we feel like we still need to make changes. But generally speaking, markets do come back and they do perform for us.
I think it's also a testament to their side is that so many advisors and so many things I see is a set it and forget it strategy, right? Just
Mhm.
do this and don't look at it. And I think us as a team really do not prescribe to that. I mean, look at it. What is happening, especially after last year? And we're going to get to this more when we talk about our client portfolios individually, but rebalancing that portfolio is absolutely critical. It helps lessen some of the rise, it smooths that ride out a little bit. It gives us a little bit of extra ammo that if there is a
Mhm.
prolonged downturn, that we have some ability to rebalance into that. And again, especially after 3 really great years in the market, is capturing some of those earnings from the portfolio and then being able to redeploy those elsewhere. So, they're in one side, it's don't react to the news, but that's not saying don't react at all. There's the rebalancing approach that we firmly believe in as a
Mhm.
company and for our CandorPath portfolio. So I think this is a great, it puts it in perspective that the news events generally are not what we trade upon. It's basically we're trading upon fundamentals. What's happening with our economy, what's happening with the markets, and are we out of our asset allocation? Are we overweight in one category that we need to pull back on and timing it that way, not necessarily timing it upon a news event, which we see time after time, with the exception of 1973, and I really call it even the first Gulf War, which was a really major deal.
Mhm.
These were all relatively 1 month or 2 month periods of time that the market took to recover based upon a news event. So fascinating look backwards.
Yep. And you
Oh,
brought up,
yep.
oh, go for
Continue.
it,
Sorry. Go
Matt.
ahead. No, I was just going to say, as you kind of talk through that, we want to then sort of translate this over to our Candor Path portfolio. So we'll go there next in a moment, but finish up your thoughts on this.
I was going to hop on to the next section, so you read
Mhm.
my mind exactly where we were going to go.
Great.
When we think about the portfolios, Matt, you highlighted a couple issues or a couple things we want to hit on, and there's a lot of numbers on this page, so I'm gonna talk through it quickly, but I'm gonna try and talk through it as simplistically as possible. When we think about the US markets, they are not cheap by any stretch of the imagination. And we've always wanted to have some exposure to international. But one of the things that we think about moving into this year is, does it make sense to add a little bit more to international? And one of the reasons that we look at that, I think, is really capsulated here in the 2025 returns for international markets, is that there's a currency differential that occurs. Because you remember, in the United States, we use dollars. We go to the store, we pay with dollars. But in Europe, there's other currencies. There's other currencies around the world, whether you're in China, India. It doesn't really matter if there's a differential because currencies are not equal. As things change, as interest rates change, what we're seeing is the US dollar is weakening relative to other currencies. That's not to say that the US dollar isn't important, but it is to suggest that there are some opportunities out there. So when we look at Europe, Asia, and the Far East, their markets went up 21%. But if you're owning it in the terms of dollars, it went up 32%. Similarly, you can look at the Eurozone and the emerging markets. When we look at all these different countries, because the US dollar is weakening versus their currencies, you actually get a higher return as a US dollar holder. So we think, hey, it might make sense to increase some international exposure because we expect the dollar to weaken further because we expect interest rates to come down a little bit further.
So basically, what you're saying is when we take the trip overseas to go to Italy, it's going to cost us a little bit more money. But if we're investing our portfolio the right way, we're making up some of that on that weakened dollar
Yes.
in local currency. And so it's a little bit of a give take there. Obviously, I'm making a little bit of light of it, but being able to denominate in local currency versus US dollar for us is a competitive advantage at this point.
Yes, absolutely. And kind of the pairing with this is because the US dollar is weakening a little bit due to us lowering some interest rates. What's the effect of lowering interest rates on our bond portfolio? And over here on the right, we look at this and there's a bunch of numbers, bunch of charts, bar charts over here. What we want to look at down here is these three different colors. We have the dark blue showing a 1% fall in interest rates. We have the light blue showing no change in interest rates. And then what happens if interest rates were to rise? Now, we don't necessarily think interest rates are going to rise, but we're probably looking in between these first two blues of what we think is going to happen in 2026. So we come over here and like to just show the US aggregate bond index. If interest rates don't move, we expect to earn the coupon, which should make sense when we think about bond math. No change, we get 4.3%. However, if we do get interest rates to come down by 1%, what does that mean for the bond? Well, you could almost make 10% in your aggregate bond index. That's not a promise that that's going to happen because there's a lot of things that go into bond math. But as interest rates fall, that makes your bond returns go up higher generally. So we're looking at there's a good opportunity to make a good earning, a good yield in bonds, and we don't have to take as much risk in the equity markets as at the moment. So framing that when we look at our portfolio, some areas of opportunity, international markets can make some sense, and bonds are really starting to perform well and pay us compared to the past 20 years.
What I think is really interesting is that both of these asset classes have been laggards over the last 10 years. I mean,
Mhm.
fixed income has, with a very low interest rate environment, have not been incredibly attractive. And the same goes for international. So I think it's also us not necessarily always looking backwards of, well, how did it, if we talk to a client and we're talking about increasing our exposure, sometimes the natural question is, well, how has it done? Well, international has not done well, but was the arguably one of the best performing, right besides commodity, one of the best performing asset classes last year. And so, not saying that we're going to double down on it this year, but us having exposure to it because we believe that there are opportunities is different than just looking backwards and saying we're going to put our money where what's won and not what's lost. And I think that's where our clients really rely on us a lot of times is to say, Matt, John, Brandon, Michael, where are there opportunities? And I think we sort of see these two places right now as opportunistic for us. And as we tilt these portfolios, because again, we have full control over these, we can start to tilt these in such a way to take advantage of what we believe to be some opportunities. And we're constantly making those changes, so it's never a one-shot deal. We have 5 minutes left in this webinar. So if you've hung on this long, we are so happy you're still here. We have 5 minutes left, and we are going to very briefly just touch on, as we do in our weekly meetings, as we talked about, we go over the full economic update. We talk about the CandorPath portfolios as we just finished here. And next, we're going to talk about our individual clients. And if you've seen this before, we break our clients up into really three major categories. We have our accumulators, those that are still in their working years. We have our pre-retirees, maybe you're just on the cusp of retirement or within 5 years or so. And then we have our retirees, who I see their names on this list. And I got to tell you, when I eventually retire, I'm not going to try to watch this stuff because I want to get away from it. But I'm saying that with a little tongue in cheek. We're really happy you're here and taking an interest in some of the things that we discussed. Let's first talk about our accumulators here with our last 5 minutes to go. What are some of the things here with our first quarterly economic update of the year? What are some of the things that they should be focusing on just as a talking point, or maybe this is what you're going to talk to your advisor about as you have your first meeting of the year?
I think the number one thing right now for accumulators, those that are in their working years, maybe in their prime working years, are we set to max our 401k? It's January. So whether you get paid monthly or you get paid bi-weekly or bi-monthly, you have 12, 24, 26 paychecks in the year. It's a lot easier to structure your income to max that 401k to the IRS limit or the max that you can do when you have a lot more paychecks to spread it out. So let's make sure that if we have a savings goal for 24,000 in the 401k or 20,000 or 15 or even if it's 10, if that's what you're capable of doing, do we have it structured the right way so we're not rushing in July to make all the contributions on half the paychecks? And similarly, that goes for the IRAs. If you're able to do both, or maybe your 401k, your work doesn't give you a 401k, are we structuring the IRAs to make the right contributions? It's January. Let's make sure we have that in place.
Great.
Second, second
Yeah,
thing
go.
there with the accumulators, we just got through the holidays. Probably have families, probably have friends.
It
We
was
probably
expensive, Michael. It was an expensive holiday.
trust me, I know. It You want to make sure that our do we dip into our emergency funds to just pay off the credit card, or do we spend a little bit more than we thought we were going to? Did food cost more? Do we go out a little bit more often? Let's make sure that we get those emergency savings back to the right number. and just have that set so that we're able to do the other things that we need to do this year and we're not underfunding ourselves and setting ourselves up for a problem later on.
Yeah, great points. And just as some of the talking points, that emergency savings, as I'm now in my 23rd year of doing this, that has bailed so many of our clients out of situations where that AC unit blows. There's an emergency that occurs, a medical emergency. Having that bucket to be able to go to, that's not
Mhm.
earning very much. It's sitting in a high yield savings account. That is because if everything you have is inside of your qualified plans, your 401ks, your IRAs, it's incredibly hard to get that back out. Sometimes there's a loan opportunity. Sometimes you're forced to make a distribution, which is not ideal at all. That savings account is absolutely critical. And I'm sure you tapped into it with an expensive holiday, especially with little ones running around, maybe. Being able to refill that here at the beginning of the year is absolutely important. And that even goes to maybe, reducing 401k contributions even temporarily to refill that savings account so you have a place to go to. So two great points. Our pre-retirees, I think, you're within 5 years or less of retirement. A big hiccup right now is a big deal. You don't have the same time to recover that our accumulators have. They have years and years and years to go before retirement or needing to use their money. But our pre-retirees are really, really in that window of needing to make sure that their asset allocation is tight. If the asset allocation has slid, if your stock exposure has slid up because the markets have just done really well over the last 3 years, it's time to pull some of that back down. Now, again, our CandorPath portfolios, we handle that here in house. But you have your 401k or clients that are outside of our firm watching this right now. Being able to realign your portfolio back to your asset allocation, back to we have an investment policy statement for each client. We know exactly where everyone should be, and this allows us to unemotionally rebalance the portfolio and bring things back in line. So absolutely critical for our pre-retirees. And of course, there's that expenses. If we're in our pre-retiree phase, we're starting to get ready for that transition to retirement. It's locking down some of those expenses. It's working with your advisor to create that financial plan. Absolutely critical, and nothing is better than the end of the beginning of the year because you have all of the data from last year to say where was our spending, what were our fixed expenses, what were our variable expenses, and as we build that retirement plan, what are we going to need to live off of moving forward? And I'll take this last one here for the sake of time, Michael. Our
Mhm.
retirees continuing to manage distributions, and I think this one is a simple statement but has a immense amount of implications. Our retirees are mostly living off of their investments, and living off our investments, especially during a volatile period, is really impactful. If that market drops down 5%, and we're taking out 5%, what do we need just to get back up to break even? Spoiler, it's not 10%. It's a number north of that. So, for all of our retirees, for the most part, we have an income strategy in place that is
Mhm.
allowing the dividends and interest to be used for income. And then we want to make sure there's a nice big cash buffer there. For most, not all, most cases, we have anywhere from 6 months to a year of their expenses sitting in a high yield money market account that allows us to draw from that as opposed to needing to sell. Because if we're having this conversation in January of 2025 and we go through the tariff crisis of the first quarter and you're pulling money out of equities or needing to sell those, it's incredibly impactful, even though the year ended up massively positive. We want to make sure we time those distributions properly and not have to sell because you need income. Having that big cash buffer is absolutely important. And then the last piece on there is checking for those senior deductions. As I start off today's call, when we worked in and did a tax analysis for our clients, we didn't have the new senior deduction in place. In fact, all the tax pro formas that I worked on for our clients just assumed that the standard deduction or their itemized were going to be the same throughout the year. And it wasn't until August or September that that new law dropped and changed the senior deduction. So, this will be impactful for those that are making married filing jointly under 150,000 over the age of 65 and 75,000 for those that are filing single over the age of 65, a new standard deduction that's an increase there, meant to offset some of that social security income that might be included, but doesn't quite work that way as we talk to a number of our clients about the mechanics of that. So some of the things to think about, to talk to your advisor about as you're having your first meetings here for the year. If you have made it this far, congratulations. You just got 45 minutes of a quarterly economic update. We are so happy you are a part of our firm. We're so happy you're listening. Please share this with any family or friends that might be worried about what's going on right now, this video will be uploaded to our YouTube channel. You can rewatch it. You can send us some notes on it. You can communicate with us about any questions you had. But we want to thank you for being a part of our firm. We're looking forward to 2026, whatever it may throw at us. Honestly, if it's a chaotic year, we have your back. If it's a smooth year, then we have that covered as well. We're excited to have you as part of our CandorPath family, and we are looking for all good things in the new year. So, on behalf of myself and Mr. Michael Scott, thank you guys so much for being a part of us for the last 45. We are here for you for any questions, comments, or concerns. We're here for you during tax season. If anything pops up and you have questions, or we might be doing a return here in-house, we're here for you guys, and we look forward to serving you for the remainder of this year. Thanks so much, guys. Have a great day.